Financial leverage is a concept widely used in the field of finance to describe the use of borrowed funds to amplify potential returns or increase the risk exposure of an investment. It plays a crucial role in corporate finance, investment management, and personal finance. This video aims to provide a comprehensive understanding of financial leverage by exploring its definition, types, and implications on various stakeholders. Definition of financial leverage. Financial leverage refers to the strategic use of borrowed funds or debt to increase the potential return on investment. By utilizing debt, individuals or companies can leverage their existing capital to finance new projects or investments. The central idea behind financial leverage is that the cost of borrowing is typically lower than the potential return on investment, which creates an opportunity for increased profitability. Types of financial leverage. 1. Operating leverage. Operating leverage focuses on the relationship between fixed and variable costs within a business. A company with high fixed costs and low variable costs has high operating leverage. By employing operating leverage, firms aim to increase their operating income and profitability. However, it also exposes them to higher risk when revenues decrease, as fixed costs remain constant. 2. Financial leverage. Financial leverage primarily concerns the use of debt to finance investments or business operations. It is commonly measured using the debt-to-equity ratio, which shows the proportion of debt used in relation to equity or shareholders' funds. A higher debt-to-equity ratio indicates higher financial leverage. While financial leverage can magnify returns, it also amplifies losses if investments perform poorly. Advantages of financial leverage. 1. Increased return on investment. ROI. Financial leverage enables individuals or companies to invest more capital than they currently possess, potentially leading to higher returns. By using borrowed funds, investors can generate more income from an investment than if they relied solely on their own resources. 2. Tax benefits. Interest paid on debt is often tax deductible, which provides a financial advantage to entities using financial leverage. This tax shield reduces the overall cost of borrowing and enhances the profitability of leveraged investments. 3. Diversification opportunities. Financial leverage allows investors to diversify their portfolio by allocating funds to multiple investments. This diversification helps spread risk and potentially enhances the overall return. Disadvantages of financial leverage. 1. Increased risk. Financial leverage amplifies the potential losses associated with an investment. If the investment underperforms or the interest rates rise, the burden of debt repayment becomes more challenging, increasing the risk of default. 2. Interest expense. Borrowing funds incurs interest expenses, which can place a significant financial burden on the borrower. High interest payments can erode profitability and hinder the ability to reinvest or allocate funds elsewhere. 3. Limited flexibility. Excessive financial leverage can restrict a company's flexibility to respond to changing market conditions or pursue new opportunities. Heavy debt burdens may limit access to additional funding or make it difficult to attract investors. Examples of financial leverage. 1. Corporate financial leverage. Large corporations often employ financial leverage to finance expansion projects, acquisitions, or other business activities. By issuing bonds or taking on bank loans, companies can access funds beyond their existing capital base, enabling growth and potentially increasing shareholder value. 2. Real estate leverage. Real estate investors frequently use financial leverage to purchase properties. They may secure a mortgage loan to cover a significant portion of the property's purchase price, allowing them to control and generate income from a valuable asset without using all of their own capital. 3. Personal financial leverage. Individuals can also utilize financial leverage to their advantage. For instance, taking out a mortgage to buy a home allows individuals to benefit from the potential appreciation of the property while only putting a portion of their own funds at risk. Additionally, individuals may use leverage in their investment portfolios by margin trading, which involves borrowing funds from a broker to purchase securities. Factors to consider when using financial leverage. 1. Risk tolerance. It is essential to assess one's risk tolerance before employing financial leverage. Higher leverage amplifies both potential gains and losses, so individuals and businesses must be prepared to bear the increased risk associated with leverage. 2. Cost of borrowing. Understanding the cost of borrowing is crucial when evaluating the feasibility of leveraging funds. Interest rates, fees, and repayment terms directly impact the overall cost of leverage and its impact on investment returns. 3. Market conditions. Economic conditions, interest rate fluctuations, and industry-specific factors can significantly affect the success of leveraging funds. It is essential to evaluate market conditions and make informed decisions based on the potential impact on investment performance and the ability to service debt obligations. 4. Cash flow management. Proper cash flow management is vital when using financial leverage. Borrowers must ensure they have sufficient cash flow to meet interest payments and debt obligations. A comprehensive analysis of projected cash flows can help assess the feasibility of leveraging funds. Risk mitigation and control measures. 1. Diversification. Spreading investments across different asset classes or industries can help reduce the overall risk associated with financial leverage. Diversification can limit exposure to a single investment and mitigate potential losses. 2. Risk management strategies. Employing risk management techniques such as hedging, options, or insurance can provide a level of protection against adverse market movements. These strategies can help mitigate the risks associated with leveraging funds. 3. Adequate capital reserves. Maintaining sufficient capital reserves is essential to ensure the ability to meet debt obligations even during periods of financial stress. Having a buffer of cash or liquid assets can help mitigate the risk of default in challenging economic conditions. 4. Monitoring and analysis. Regular monitoring and analysis of leverage ratios, interest rates, cash flows, and market conditions are crucial to identifying potential risks and taking appropriate actions. Constant evaluation of the leverage position allows for proactive risk management. Conclusion. Financial leverage serves as a powerful tool in finance, enabling individuals and businesses to leverage borrowed funds to potentially increase returns and expand investment opportunities. However, it is important to approach financial leverage with caution and careful consideration of the associated risks. Understanding the different types of leverage and their implications on profitability, risk exposure, and financial flexibility is essential for making informed decisions. By implementing risk mitigation strategies and maintaining prudent financial management practices, stakeholders can effectively navigate the complexities of financial leverage and leverage its benefits while minimizing potential drawbacks.